Corporate finance practice problem using OneNote. Impact of inflation on borrowing. Get ready, it's time to take your chance with corporate finance. Here we are in OneNote. If you have access to OneNote, would like to follow along, you're not required to, but if would like to, we're in the icon on the left-hand side. We're in the Practice Problems tab, then down in the 1624 Impact of Inflation on Borrowing tab. Also note, when using OneNote, look at the Immersive Reader tool. Our practice problems will be down here in the text area as well. Same name, same number, but with transcripts that can be translated into multiple different languages and either listened to or read in them. Closing the icon, information up top, calculations on down below. The scenario is we're imagining we borrowed $100,000 15 years ago. Compound inflation rate per year is about the 5%. So we want to think about the impact of inflation on borrowing. And as we do this, you want to keep this a little bit separate when we look at our discounting rate and our present value and future value types of calculations. You got to keep it a little bit different when you're thinking about different things that you're trying to do. Here we're looking at inflation, which is the time value of money, meaning over time, usually if you're talking US dollars, we're talking that there's going to be inflation, meaning the purchasing power of the dollar will actually be declining. You can purchase less things with the same dollar over time. Usually in the US, that's a pretty stable type of thing. So you got anywhere from 1 to 3 to 5% possibly on the inflation. But there are times, of course, when inflation can get higher. And what would the impact be when that is the case? That's a little bit different than a calculation. For example, if you were to do a future value calculation of the sort where you're thinking about investing $100,000 into some kind of stock or some type of investment, and you're trying to see where you will be at the end of that investment. Usually you're not thinking about simply inflation in that case. You're thinking about what your return will be to see where you will be at the end of that investment. And also, when we've done our net present value types of calculations, say we have a future stream of flows that we're trying to bring back to a current time period, and we're doing our net present value, oftentimes we're calculating, for example, in our capital budget type of calculations, we're including in there what our rate of return will be, not just inflation, in other words. So now we're talking about just inflation. So we're thinking about just the purchasing power so that we can basically be comparing the same thing to the same thing in different time periods with regards to the purchasing power of the money. Now, there's a couple different ways that we could do this. And we'll think about them in a couple different ways, but that's the first thing you want to keep in your mind, what we're talking about with regards to inflation as opposed to a rate of return that we would be receiving or something like that. Now, inflation can be a little bit difficult to calculate on a year-to-year basis. So it's something that's a little bit difficult to measure. We have to basically estimate what the inflation will be. So we'll do this, we'll think about it just a couple different ways, but basically we can use the present value and future value calculations to do these calculations with regards to inflation. But let's say we have the compounding inflation rate per year of 5%, and let's just think about what the impact of that would be if we started off with $1,000. In other words, what would be the impact of inflation? Where would we be at the end of the 15-year time period if we had basically the 5% inflation that was compounding each year? So we'll work this out with a table. After year one, you'd have the 1,000. I'm sorry, in year zero, we got 1,000, and then the inflation would, of course, be the 1,000 times the 5%. So 1,000 times 0.05, that would give us $50. So now after year one, then the 1,050 would have the same purchasing power we're imagining as the 1,000. So it's not like we made $50 in that case. We're saying that in this case, after 1 year, you'd need $1,050 to purchase the same basket of goods, as they might say from economic terms, as you would from year one for the $1,000. And then we would take that 50 plus the original 1,000 times then the 0.05, it being compounding, we're at the 5,250. If we take that plus the 1,050, we're at the 1,102.5, and once again, we'd have to say after 2 years, we would need $1,102.5 to purchase the same basket of goods as we could have purchased in year one for simply the $1,000. So we didn't get more money. We got more money in essence, but the more money isn't giving us any more purchasing power being the idea here. So then year three, we'll do this one more time. We're going to say then we'll take that times the 0.05. It's going to give us the 55.13 plus the prior amount of 1102.5 is going to give us, hold on a second, 1102.5 plus 55.13 is going to give us the 1157.63. So after 3 years, we would need 1,157.63 to purchase the same basket of goods as the 1,000 for year one. So when you look at this calculation, you might think, well, this looks like a typical kind of investment type of calculation, right? We started at the 1,000. We are then seeing where we will be at the end of kind of an investment calculation. But in this case, we're not thinking about investment. We're trying to think where we would need to be just to clear the hurdle of the decline in the dollar so that we have the same purchasing power at the end of that time period. So it's not like we're benefiting here. In this case, we're trying to basically see what we need to do to stay the same given the economic condition of the inflation. So we're going to end off then after 15 years at 2,078.93. So that means that this 2,078.93 is where we would need to be after 15 years in order to be in the same place with regards to actual purchasing power as the 1,000 in year zero. So it looks like a kind of investment type of calculation, but of course it's really trying to see how to get to the same point, at the end of the 15 years in terms of purchasing power. Now, if we compare that to the original value, then we get our difference, right? So if I say this is where we need to be after 15 years, 1078.93 minus the 1,000, our starting point, then we have a difference of 1,078.93. If we take that difference and compare it to the original amount, taking that divided by, in other words, the 1,000, then we have if I move the decimal 2 places over, the 107.89%. And we can call that the cumulative inflation rate, meaning this is kind of the inflation after that full time period, which is how you might see basically the inflation. If you're not used to seeing a number like that, then that can be a little bit confusing to you. So you could see what happened here, right? We're taking, basically the purchasing power of where you would need to be in the same point over the full 15-year time period to have the same purchasing power. In other words, you would need 2,078.93 to have the same purchasing power as the 1,000 before. And notice we started at 1,000 just arbitrarily. We could have started at 100 or 1 or 2 or whatever we wanted to, and we would get the same kind of comparison relationship between the numbers. And then we got the difference here, comparing that to the original amount, that being the difference. And then we're taking the difference, 1,078.93, divided by the original amount, so that basically the change divided by the original to give us that 107.89. So you can think about that as a common kind of calculation for our percent increase. It's our percent increase. This is where we ended off at. This was our beginning point at beginning to the end of 15 years. There's our difference. Then you take the difference and divide it by the beginning point, the 1,000, to get our percentage increase. In this case, the 107.89. So that's one way we can look at it. So then, if we can also do this with a formula. So you're probably saying, why don't I just do this with a future value formula? And you could do that if you have the formatted as 5% compounded yearly, right? If they tell you that, then you could do that. But you might just simply be given the cumulative inflation rate depending on how the format of the problem is going to be formatted. So if they give it to you in this format, right, the compound inflation rate, then you can use your standard future value formula to get there. So we might then say, well, the future value formula would be negative future value, and it's going to be the rate, which is going to be the 5%, comma, number of periods is going to be 15, comma, because it's not an annuity, but future value of 1 to get to the future value. And then you got the present value of the 1,000. So the 100,000. And that would then give us to that 2,078.93 as well, just as this one. Again, you're probably used to this future value formula possibly being used in a situation where you're thinking about investing something today, and then you're thinking about where you will be if you were to receive a 5% return, right? And you'd be that means that at the end of the 15 years, you would have $2,078.93. Same kind of calculation here, except that 5% return doesn't really represent any benefit to us. It just represents what we need to get, or the return that needs to be there in order for us to have the same purchasing power at the end as we do today. Obviously, we calculate that inflation into our decision-making process when we determine the rate of return that we would want to get for a particular investment. But you need to realize when you're talking about just the inflation versus the rate of return that you're going to get on it. So then you can compare that to the 1,000. The difference is going to be the 1,078.93. Compare that to the original value, and that's going to give us our percent increase again, the 107.89. Same thing we got here up top. So once we have that, we can then look at the effective purchasing power. So we can take the 100,000 and we can compare that to the 1 plus the cumulative inflation. So we've got the 100,000, that's our investment, and then 1 plus the cumulative inflation is 1 plus the 107.89. So in other words, we're taking the cumulative inflation rate, let's do it this way, 1.0789 plus 1 gives us the 2.0789, or the 207.89. And then we're going to take that, and then let's do it this way. We're going to take the 100,000 divided by the 2.0789, and that's going to give us our 48,101.71. So the 48,101.71, and that means that the effective purchasing power at the end of 15 years, if we still had that loan, if we still had that $100,000, the 100,000 is now only worth the 48,101.71. Now again, you could do that calculation, meaning if I had the 100,000 after 15 years, I can only buy the equivalent basket of goods as the 48,101.71 if I had them at period 0. You could do that formula if you had it formatted this way, with the compounded rate of interest using a present value type of calculation. However, you might not have that. They might give you might see something giving you simply the cumulative inflation rate, in which case you'd have to do this calculation, right? But if you were given this 5% number, you can then do our present value calculation, where you'd say it's the present value of the rate, which is going to be the 5%, comma, number of periods, which is going to be the 15, and then comma, and the future value is going to be the 100,000. And that would mean that if you basically present valued that back, you'd be at the 48,101.71. Now, this looks something similar to like the capital budgeting type of calculations we might do for the net present value calculations, where we're taking future cash flows and pulling them back to the present. And then we often said that, hey, if it was 0 or above, we'd accept the project, and so on and so forth. But in this case, we're using a rate here. It's not the discount rate. It's not the cost of capital rate. It's not like the hurdle rate here. We're using the inflation rate. So this is telling us basically, where we would be to be at an equivalent unit, meaning, if I had 100,000 15 years from now, and I pulled that back to the current day, just looking at the purchasing power of the dollar, we're bringing that back to the 48,101.71. So again, you're similar kind of use of the formula, but when we pull that back to the current day, we're not including our value in it with regards to our return. We're just looking at the inflation to look at the purchasing power of the dollar. So if the loan is to be paid in equivalent purchasing power, how much would you need to pay it? So let's imagine then that we still have the $100,000 loan out, and that we had an agreement that we needed to pay it back in equivalent dollars, meaning we didn't have a fixed rate on it. We have to basically have a floating rate, and we have to pay it back in accordance with whatever the equivalent dollar is in the future. So how much would we have to actually pay off after 15 years if we have that 100,000 and now we have to pay it off 15 years later? Well, then we can take the loan amount of the 100,000, and we can take that times 1 plus the cumulative inflation rate. So we have the cumulative inflation rate, the 107.89 plus 1 is the 207.89. The 100,000 times the 207.89. Let's just do that for the fun of it. 100,000 times the 2.0789 is going to give us the 207,892 about. There's rounding that's involved here. So this can be a little confusing because they could just simply give you this cumulative inflation rate and force you then to calculate this number based on that cumulative inflation rate. However, you might, if you're given the information in this format, the 5% compounded yearly, you can use the future value calculation to get there as well. The future value calculation would simply be the future value of the rate, which of course would be the 5%, comma, and then you got the number of periods, which would be 15, and then comma, comma, because it's not an annuity, and then the present value would be the 100,000. So now we're thinking we start at the 100,000 and say, okay, where would we be at the end? Where would we need to be in terms of dollars in order to be basically at equivalent units given that inflation rate? And that would give us the 207,892.82. So if we started at the 100,000 at period 0, and then we wanted equivalent dollars 15 years from now, given that 5% inflation rate, we would be at the 207,892.82. And let's just see that in terms of a table. This is the same kind of calculation table that we saw previously. Or actually, let's prove this one with a table. So we'll do this from the 48,101.71 to get to the 100,000. You could do the same kind of table between the two time periods. Period 0, if we started at the 48,101.71, and then we said after 1 year, where would we need to be? We'd have to take then this 48,101.71 times 0.05, and that would give us the 2,405.09 plus the 48,101.71. That would give us the 50,506.50. So in other words, if I started out at the 48,101.71, after 1 year, I would need 50,506.8 in order to have the equivalent purchasing power to buy the same basket of goods as the 48,101.71 in period 0. Let's just do one more here. If I take that, multiply it times 0.05, interest is now at the 2525.34. Adding that to the 50506.8, we're at the 5332.14. And so after 2 years, I would need 5332.14 to buy the same basket of goods as the 48,101.71 in period 0. So if I did that all the way down, that would get us to our 100,000 on the future value, just to give us a table format to see how that would work. You could set up a similar table here, and if I had the starting point, if I said the starting point was at the 100,000, and then I did the same calculation on a table format, you'd get to the end result here in terms of a table to be the end point of the 207,892.82.